forexbrokers.net, and we continue with the third and last part of the video section dedicated to the Bollinger Bands Indicator. So far we've looked at what the standard interpretation of the indicator is, what the 2v2 setup based on the rejection on the middle Bollinger Band is, and also how to trade the breakouts of the upper or lower edges of the indicator on the presumption, or using the presumption that the price anyway spends almost all the time between the edges, the upper Bollinger Band and the lower Bollinger Band, and therefore we use a bit that breakout to interpret the market. But another and a different way to trade with the Bollinger Band is to use it as a volatility indicator. Namely, this indicator shows also a breakout when the edges, not the middle Bollinger Band, but the upper and lower one, the edges of the indicator shrink or expand consistently. And to do that, one thing or the first thing to interpret is to wait for the bands to contract in an unusual manner. Contracting in an unusual manner, it means that for instance, take this candlestick. This is the upper Bollinger Band, this is the lower Bollinger Band. So the distance between the two bands is quite big. But if you look here, the distance shrinks. If you look here, the distance shrinks even more. If you look here, the distance shrinks even more. Now the key to this trading strategy is to find out or to check historical prices, historical levels on each currency pair, on each time frame, because they are all important, and to try to find out measure move for the Bollinger Bands approach or narrowing before a breakout. For instance, if you go on your keyboard and you push the home button here, we can go and check historical levels. Now this is still too wide, then it narrows, and so this would be a nice standard move if you want, or measured move for what's happening before a breakout, or what's happening usually before an important economic release. And so when the market consolidates a bit, Bollinger Bands tell here that the breakout comes, and it is very important to be on the right side of the market. So in order to measure this one here, all we gotta do is to take two horizontal lines like I did here, this one and this one, and measure it, and then apply it on new setups. Coming back to this setup that we had here on the euro and Australian dollar. This is the hourly chart. Assuming that this is our measure move, this is what's happening before a breakout, then the rules are the following. We simply wait for the market to break. So this is where the upper and the lower Bollinger Bands, they shrink more than our measure move. This is the measure move. They shrink more than our measure move. They can go even more. But then a breakout comes. This is a false breakout. Why? Because the rules for this strategy call for the bands to widen at least more than half of the distance of this channel. Well, if you add this to this is not half of the distance, and therefore the breakout is still valid. The market reverses, and this is our entry. By the time that the price reaches here, as you can see, it happened over the weekend, as this was the closing on Friday and this is the opening on Monday. It is the only possibility for the market to gap when you trade the currency market. And the distance from here, the upper Bollinger Band, to here, the lower Bollinger Band, exceeds 50% of the measure move. So this is the entry place, and therefore the breakout is bullish, and all we gotta do then is to follow the bullish trend as long as the market remains into the upper side of the rising channel we should stay on the long side. Or we could use reversal patterns like we've discussed on the previous videos. This one might be a reversal pattern if you consider that it's valid, and so on. But what's more important is to use again risk-reward ratios. Money management is very, very important, because trading financial market doesn't imply or doesn't give you 100% strategy that works all the time. It gives you a relative entry. As you can see, you should fear false breakouts. It gives you a relative exit, but having a money management setup and the risk-reward ratio would make sense in all trades. So here, this is the entry. Place the stop loss at the low. Target 1 to 2 risk-reward ratio. So this would be the risk. This would be the reward. 1 time, 2 time, and that's pretty much it. So what should happen now moving forward? Well, let's see on this euro and Australian dollar. We simply take our measure move. We see that there's no breakout so far, not even here, not even here, not even here, not even here. It's no breakout, but this one here looks almost there when it comes to our measure move. Still not quite. This one here looks like, let's try to check it. So this would be the measure move. This is the upper Bollinger Band is here. The lower Bollinger Band is here. It is still not quite into the, not smaller than the measure move, but nevertheless, if it would have been smaller than the measure move, then we simply wait for the breakout here, go on the short side, stop loss at the highs, targeting the 1 to 2 risk-reward ratio. Maybe here, probably here. Anyways, another possibility to go on the short side by the time that the 50% distance of the channel is being traveled. Now, the beauty of this strategy is that always, but absolutely always, the two bands shrink before an important market breakout. And this is what traders want to do. This is what traders want to trade, a breakout. For instance, this one here shrank more than our measure move. Simply wait for the two bands to exceed 50% before going on the long side. This would be the risk, this would be the reward, 1 time, 2 times. And now you have the second example. Using this example on other currency pairs, on other markets available to trade on the FX platforms and so on. And you'll see that it is an approach that provides good risk-reward ratios, excellent money management setups, and almost always traders end up on the right side of the market. So you have now 3 strategies to pick up, to work with when it comes to the Bollinger Bands Indicator. Again, one of the most popular indicators, initially built for trend analysis, but as you can see, setups using the volatility component are quite impressive. Bye-bye.